In this short video, I want to look at a part of the financial markets that a lot of people find a bit baffling. It's the biggest market in the world, it's fast moving, it's 24-hour and it's packed with jargon. But don't be put off, because if you're planning a holiday, if you're running a portfolio with international investments and all you own assets overseas, you do need to get to grips with just the basics at least of the foreign exchange market. And it's those basics I want to strip down and have a look at right now. So, first of all, the basics of the structure of the market. It's a zero-sum game, the foreign exchange market, so it's a little bit different to the equity market. In the equity market, Tesco can move up or down independently of, say, Sainsbury's or other food retailers or the wider market. In the currency market, things come in pairs. So a currency will strengthen, rise or weaken, fall against another currency or maybe a basket of currencies, but the point is it won't move independently. And that means the currencies come in pairs. So a typical quote might be GBP, to use the three-letter acronyms, and against USD. Now all that means is you are being told the exchange rate for pounds, shortened to GBP, against dollars. Pound being the so-called base currency on the left-hand side there. All right, and every currency has a three-letter acronym, and I've put some of the more common ones up here. But just bear in mind that there are plenty more to reflect all the currencies that are around. Now, basics. An exchange rate is simply the price of one currency against another. So what's that strengthening and weakening stuff I was talking about just now? Well, if a pound on the left, the base currency, is currently worth $1.60, the pound would be said to strengthen if it moved to, let's say, being worth $1.80. Conversely, that would be the dollar weakening. All right, we tend to talk about the currency on the left of the quote, the base currencies, that's the pound strengthening. Equally, if a pound only buys $1, let's say, 40, then not surprisingly you talk about the pound weakening or falling. Weakening is the jargon that's generally used, or the dollar strengthening conversely. But the point is you always talk about a pound doing something in relation to something else. All right. Now, other jargon that's key. The previous example used one price. That's a little bit unrealistic, same as it would be in the equity market or the bond market, because actually there are two prices at any given point in time. There's a bid price and an offer price. All right, so there's a price at which currencies are bought, there's a price at which currencies are sold, and the difference is called the spread, and that can be relatively wide or relatively narrow. Now, we'll look at an example of that in just a moment, but just be aware that there are also two basic rates in play in the foreign exchange market, and we'll look at both briefly here. There's the rates applicable for a deal now, today's rate, so-called spot rate, and there's the rate agreed now, but applicable at some point in the future. That's called a forward rate, and we'll look at both briefly in this short video. Right, so let's turn that into a practical example. So, very straightforward example, you want to change £1,000 into US dollars. You are presented with a quote that looks something like this. First of all, you've got those three-letter acronyms. All right, GBP US dollars. That just says you're being told the rate. Okay, for pounds into dollars, it's basically a two price exchange rate, and that is 167.90 on the left, 167.93 on the right. So there is a gap between the bid and the offer price, and the gap is the spread. Not very much in this case. Also note that the price on the right, which is in dollars basically, is quoted to 4 decimal places, and that's quite common. Sometimes you see 5. Now what does this mean then? Do you want to change £1,000 into US dollars? Well, there's your bid price on the left. There's your offer price on the right. And there's an important thing to remember here. These are quotes, if you like, from the bank or currency service provider's perspective. So, out on the left-hand side of this quote, that's the rate at which the bank, if you're using a bank, buys sterling, and that's the price at which it sells sterling, literally offers it. So, just to wrap up the example, if you want to sell, effectively, £1,000, the bank's going to buy it at 167.90 and hand you, ignoring commission, $1,679. all right, in that very straightforward example. So just make sure, as you would have to in the equity market, the bond market, you're looking at the right side of the two-way quote. Now, so far so good, but I did mention there were forward deals too. That's just a basic spot deal. So you're going to remit 500,000 Aussie dollars this time from the sale of an Australian property in 6 months' time back to the UK. All right. Now, what are your choices? You could simply wait and see what 500,000 Aussie dollars is worth in sterling when you eventually remit it back to the UK. But your problem's this: the exchange rate, sterling Aussie dollars, could move over the next 6 months, and we'll look at what might move the exchange rate in just a moment. But you don't know for sure what that's worth in sterling. You know you're getting 500,000 Australian dollars, but you don't know what that's worth in sterling. So an alternative is to approach a bank or currency service provider now and say, give me a rate. Give me literally a forward rate. Let's agree a rate now at which we will convert that 500,000 Aussie dollars when it comes in. So you could hedge, as it's called. Flash way of saying you could protect yourself by selling your Aussie dollars forward. And notice something here. Okay, let's do a quick comparison. Let's imagine you were changing the 500,000 Aussie dollars into sterling right now at the spot rate. Notice I'm saying that would be worth around £278,118. But if you're going to do it at the forward rates, you're agreeing that rate now. What it means is when you remit the $500,000, you will effectively sell them to a currency provider or bank, and they will give you sterling. They will give you 275,043. Why is that? That's not as much, it's a bit less. Okay. Well, that reflects the fact that at the moment, the time of shooting this video, interest rates in Australia are higher than interest rates in the UK. So someone who switches Aussie dollars now and banks the money is going to be earning less interest over the next 6 months than someone who hangs on to Aussie dollars, and that's reflected in those amounts. Okay, you get a bit more now for switching back into sterling, where you'll earn a low rate, than keeping the Aussie dollars, okay, and switching in 6 months' time, because in the meantime you can earn a bit more interest. All right, so just bear that in mind, and it leads me on to a point on the very last slide. But before we get there, is that the only use of forwards? Well, no, there are lots of use of currency forwards. I mean, imagine you're a UK firm. You export goods to the US, to Africa, over to the Far East and so on, and as you do so, you invoice in the local currency. So your American customers want to be invoiced in dollars, not sterling. Your African customers will be invoiced in the local currency, not sterling. Same for your Far Eastern customers. So your problem is, in the future, because people take a while to pay, you're going to have receipts coming in of cash amounts in all sorts of different currencies, and you have no idea what they're going to be worth, because it depends on the exchange rate and what happens to it in the meantime, between the point where you issue the invoice and the point where you receive the cash. Well, forwards are a great way to solve the problem for a company. They can basically strike a deal with a currency provider or a bank to sell amounts of a particular local currency forward, locking in the exchange rate back into sterling. Okay, going to wrap up with a point I mentioned just now on the previous slide. What, therefore, moves exchange rates? Long term, it's interest rate or interest rate expectations. Essentially, imagine you've got a situation where in one currency you can earn 1% on a deposit, in another currency you can earn 10%. Having that currency on deposit, people are going to tend to think, well, that's looking good. I mean, there may be more risk over here, but, crikey, 10%, that's attractive. So that is going to tend to strengthen the currency that's offering the higher interest rate. All right, and as interest rate expectations change, so the exchange rate will tend to shift in anticipation. But that's kind of the medium to long-term picture. In the short term, almost anything can move an exchange rate. You'll see this happening as data's released relevant to a particular economy, like the UK economy. It will move sterling, whether that's jobs data, growth data. Okay, it could be some political event. Anything that could influence the underlying economy can influence the exchange rate, can influence the currency. So just bear that in mind. All right. So there you have it. Hopefully a quick tour to basic foreign currency jargon, the difference between a spot and a forward rate, and a very brief tour of the kinds of things that can change an exchange rate.